In this chapter, the author shares a personal story about their grandfather's gambling addiction and how it led to financial ruin. They then introduce the concept of just keep buying, a mantra that can help individuals build wealth through consistent investing. The author explains that it doesn't matter when or what you buy, as long as you keep buying income-producing assets like stocks, bonds, and real estate. They emphasize the simplicity of this approach and how it can be implemented easily with the availability of free trading and fractional share ownership. The author also mentions that the book will address common questions in personal finance and investing, providing data-driven answers that may challenge mainstream advice. The goal of the book is to help readers save money, build wealth, and make smarter financial decisions. The first chapter will explore whether individuals should focus on saving or investing based on their current financial situation. In this chapter, the author shares a personal story about their financial journey and the mistakes they made when it came to saving and investing. They explain how they were so focused on analyzing their investment decisions and trying to maximize their returns that they completely neglected their income and spending habits. They would regularly spend large amounts of money on dinners, drinks, and transportation, without realizing that they were essentially wasting their investment returns. The author emphasizes that financial priorities should be based on individual financial situations. For those with limited savings, the focus should be on increasing savings and investing. However, for those with a sizable portfolio, more time should be spent on the details of the investment plan. The author uses the phrase saving is for the poor and investing is for the rich to highlight this concept, but clarifies that it is not meant to be taken literally. They suggest using a simple calculation to determine where one falls on the save-invest continuum and adjust their focus accordingly. The chapter concludes by explaining the importance of shifting focus from savings to investments as one ages, as investments become a larger contributor to wealth growth over time. The author provides a visual representation of this transition and emphasizes the significance of understanding where to allocate financial attention for the best return. The chapter sets the stage for the rest of the book, which will delve into both saving and investing strategies. In this chapter, the author uses the example of Dolly-Fiverden charfish in southern Alaska to illustrate the concept of phenotypic plasticity, or the ability for an organism, just like the charfish adjust their caloric intake based on the availability of food. The author argues that individuals should save money based on their financial circumstances. The author criticizes common savings advice that suggests saving a fixed percentage of income, as it fails to account for fluctuations in income and the fact that individuals at different income levels. Research shows that income volatility has increased over time, and individuals with higher incomes tend to save a larger percentage of their income. Instead, the author suggests saving what you can based on your income and spending. By calculating your monthly income and fixed expenses, you can determine how much you can save each month. The author acknowledges that tracking every dollar spent can be time-consuming, so they recommend focusing on fixed expenses and estimating variable expenses. The author emphasizes that the best savings advice is to save what you can, as stressing about not saving enough can be more harmful than the act of saving itself. They cite research showing that money consistently tops the list of stressors for Americans and that financial stress can have negative effects on overall well-being. Furthermore, the author challenges the common fear of running out of money in retirement, citing studies that show many retirees actually don't spend more than their annual income and end up living. They also mention that millennials are building wealth at a similar pace to previous generations, despite concerns about their financial future. In conclusion, the author argues that individuals should save based on their own financial circumstances rather than following fixed rules. By saving what you can and avoiding unnecessary stress, you can achieve a healthier relationship with money and enjoy your financial resources. In this chapter, the author challenges the conventional wisdom in personal finance that cutting spending is the key to saving more money. They argue that, similar to the relationship between exercise and weight loss, cutting spending has inherent limitations when it comes to saving money. The author presents data from the Consumer Expenditure Survey, showing that many low-income households already spend their entire paycheck on necessities, leaving little room for further cuts. They also highlight that higher-income households spend a smaller percentage of their income on necessities, indicating that increases in income are not followed by similar increases in spending. The author then debunks the biggest lie in personal finance, which is that cutting spending alone can make you rich. They argue that the most consistent way to get rich is to grow your income and invest in income-producing assets. The chapter concludes by discussing 5 methods to increase your income: selling your time expertise, selling a skill service, teaching people, selling a product, and climbing the corporate ladder. The author emphasizes that these methods should be viewed as temporary measures and that the ultimate goal should be to use the additional income to acquire more income-producing assets. They encourage readers to think like owners and invest in long-term wealth building. In this chapter, the author presents 2 different approaches to spending money guilt-free. The first approach is called the Twax rule, which involves investing the same amount of money as a splurge purchase. For example, if you want to buy a $400 pair of shoes, you would also have to invest $400 in stocks or other income-producing assets. This rule helps you reevaluate how much you really want something and removes the guilt associated with spending. The second approach is to focus on maximizing long-term fulfillment rather than immediate happiness. This involves considering how a purchase aligns with your values, goals, and sense of purpose. By framing purchases in terms of fulfillment, you can make spending decisions without guilt. The author emphasizes that there is no one-size-fits-all approach to spending money and encourages readers to figure out what works best for them. Ultimately, the only right way to spend money is the way that aligns with your own values and brings you fulfillment. In this chapter, the author tells the story of the 500 family and how lifestyle creep led to their financial downfall. The 500 one of the richest families in America, indulged in extravagant spending to keep up with their peers, ultimately depleting their wealth. The author argues that while some lifestyle creep can be satisfying, it's important to set limits. They suggest that spending more than 50 of future raises can delay retirement. The author uses a thought experiment to demonstrate why higher savers need to save a larger percentage of their raises to maintain their retirement date. They provide a table showing how much of a raise should be saved based on current savings rates. The author concludes that saving 50 of raises is a practical solution for most people. They compare this to the Twax rule, which advises setting aside an equal amount of money for income-producing assets when making expensive purchases. The chapter ends by introducing the topic of going into debt and whether it is ever advisable. In this chapter, the author explores the question of whether debt is always bad or if there are situations where it can be beneficial. The chapter begins with an analogy about desert plants and their survival strategies, introducing the concept of bet hedging as a risk reduction strategy. The author then applies this concept to debt, arguing that debt can be a form of bet hedging for certain individuals. The chapter discusses how credit card debt, often seen as universally bad, can actually be a way for low-income borrowers to reduce long-term risk. The author presents research that shows some individuals choose to hold onto credit card debt despite having the means to pay it off, as a way of ensuring future access to funds. Similarly, the chapter highlights how some of the world's poorest people use debt as a means of saving money. The chapter also explores the question of whether college debt is worth it. The author presents data on the lifetime earnings of college graduates compared to high school graduates, showing a significant earnings premium for those with a college degree. However, the author acknowledges that the decision to take on college debt depends on the expected increase in lifetime earnings and the cost of attending college. The chapter concludes by discussing the non-financial costs of debt, including its impact on mental and physical health. The author emphasizes that debt is not a one-size-fits-all solution, and that individuals should consider their own attitudes towards debt and their ability to manage it before making a decision. Overall, the chapter challenges the notion that all debt is bad and encourages readers to consider the context and potential benefits of taking on debt. It provides a nuanced perspective on debt and offers insights into when debt may be a strategic choice. In this chapter, the author explores the age-old question of whether it's better to rent or buy a home. They begin by sharing a personal story about their grandparents, who purchased a home in 1972 that has since increased in value by a factor of 3. The author reminisces about the memories they have in that home and the emotional return on investment it provided. However, the author also highlights the many costs associated with homeownership. They discuss the one-time costs, such as down payments and closing costs, as well as ongoing costs like property taxes, maintenance, and insurance. These costs can range from 5.5 to 31 of the home's value, making homeownership a long-term commitment. On the other hand, renting has its own set of costs and risks. Renters face long-term uncertainty in housing costs, instability in their living situation, and the need to move more frequently. However, the author notes that renting eliminates the risk of a poor return on investment, as housing has historically had a low inflation-adjusted return. Despite the financial considerations, the author emphasizes the societal reasons for homeownership. Owning a home is seen as a way to accumulate wealth and is a socially acceptable choice. The author cites data showing that homeownership rates increase with higher levels of income and wealth. Ultimately, the author suggests that the decision to rent or buy should be based on personal and financial circumstances. They outline 3 conditions for buying a home: planning to stay in the location for at least 10 years, having a stable personal and professional life, and being able to afford it. They also recommend saving up for a 20 down payment and waiting for a larger home if possible. In conclusion, the author encourages readers to carefully consider the costs and benefits of renting versus buying a home. They emphasize the importance of making the decision that is best for both personal and financial situations. In this chapter, the author discusses the best strategies for saving for a down payment or other big purchases. They emphasize the importance of considering your time horizon when deciding how to save. The author explains that while cash is the safest option for short-term savings, it is not ideal for longer periods due to the impact of inflation. They compare saving in cash to saving in bonds and find that bonds generally outperform cash over a 2-year time horizon. However, for savings goals beyond 2 years, investing in stocks may be a better option. The author cautions that investing in stocks comes with more risk and may require adjusting your savings strategy in response to market conditions. Ultimately, the author advises adapting your strategy based on the investment options available to you and your specific goals. In this chapter, the author explores the question of when one can retire and why money isn't the most important factor in retirement planning. The chapter begins by acknowledging the difficulty of predicting one's financial future and the uncertainty of investment returns and lifespan. The author introduces the 4 rule, which states that retirees can withdraw 4 of their investment portfolio annually for at least 30 years without running out of money. This rule provides a simple solution for determining how much one can spend in retirement and how much they need to save. However, the author also acknowledges that spending tends to decline in retirement, contradicting the assumption of the 4 rule. They introduce the crossover point rule as an alternative method for determining when one can retire, which focuses on when monthly investment income exceeds monthly expenses. The chapter concludes by emphasizing that retirement is not just a financial decision, but also a lifestyle decision. It highlights the importance of finding purpose and fulfillment in retirement beyond financial security. The author cautions against solely focusing on financial independence and early retirement, as it may not lead to happiness and satisfaction if other aspects of life are neglected. In this chapter, the author discusses 3 primary reasons why you should invest your money. The first reason is to save for your future self. With the concept of retirement becoming more prevalent due to increased lifespans, investing allows you to have a pool of resources to draw upon in old age. Research has shown that thinking about your future self is one of the best ways to improve your investment behavior. The second reason to invest is to preserve your money against inflation. Inflation is an unavoidable reality that erodes the value of your currency over time. By investing in assets that preserve or grow their purchasing power, you can counteract the effects of inflation and protect your wealth. This is especially important for retirees who will be faced with higher prices without the benefit of earning higher wages. The third reason to invest is to replace your human capital with financial capital. Human capital refers to the value of your skills, knowledge, and time. While your skills and knowledge can increase throughout your life, you will never get more time. By investing, you can turn your diminishing human capital into productive financial capital that will provide you with income in the future. Overall, investing is crucial for saving for your future, preserving your wealth against inflation, and replacing your human capital with financial capital. It is a way to ensure financial security and provide for yourself in old age. In this chapter, the author explores various income-producing assets that individuals can invest in to build wealth. The author emphasizes that there is no one true path to wealth and that different investment strategies work for different people. The chapter begins with a story about a judo instructor who realized that not everyone learns the same way, highlighting the importance of individualizing investment strategies. The author then discusses the need to explore different paths and continually buy a diverse set of income-producing assets to build wealth. The chapter focuses on four main asset classes: stocks, bonds, investment property, and real estate investment trusts rights. For each asset class, the author defines what it is, examines the pros and cons of investing in it, and provides guidance on how to invest in it. The author also briefly mentions other asset classes such as farmland, small businesses franchise investing, royalties, and your own products. The chapter concludes by emphasizing the importance of finding the right asset allocation that works best for each individual's situation. In this chapter, the author shares a personal story about his friend Darren, who wanted to invest a large sum of money in GameStop after hearing about its skyrocketing stock price. Despite the author's advice against buying individual stocks, Darren went ahead and made the investment. Within a short period of time, the stock price fluctuated dramatically, causing Darren to experience both excitement and anxiety. Ultimately, he ended up losing $12,000 in just 2 hours. The author goes on to explain why buying individual stocks is not a wise investment strategy. He presents the financial argument, which states that most people, including professionals, are unable to consistently beat the market. Research shows that only a small percentage of individual stocks perform well in the long run, and even those winners eventually lose their edge. The author emphasizes that owning a diversified portfolio, such as an index fund or ETF, is a safer and more profitable approach. However, the author believes that the existential argument against stock picking is even more compelling. Unlike other domains, where skill can be quickly assessed, determining whether someone is a good stock picker takes years. The feedback loop is delayed, and the result may not be directly linked to the decision made. Additionally, even if someone demonstrates skill in stock picking, they are still susceptible to periods of underperformance, which can be mentally and emotionally challenging. The author concludes by urging readers to track their performance if they choose to invest in individual stocks, but also encourages them to consider the emotional, financial, and existential costs. Ultimately, the author advocates for investing in index funds and its allowing individuals to focus on more important aspects of life. In this chapter, the author discusses the importance of investing as soon as possible and why earlier is better than later. The chapter begins with the story of Jeff Sater, an analyst turned horse race predictor, who discovered that the size of a horse's heart was a better predictor of racing success than pedigree. This story illustrates how deep insight can be gleaned from a single useful data point. The author then introduces the concept that most stock markets go up most of the time, despite the chaotic course of human history. This empirical evidence suggests that investing sooner rather than later is the best strategy. The author presents a thought experiment where an investor is given $1 million and must choose between investing all of it immediately or investing one each year for the next 100 years. The experiment shows that buying now is better than buying over time, as waiting means buying at higher prices in the future. The chapter also addresses the common belief that waiting for a better price in the future is the right decision. The author explains that while it is likely that a better price will appear at some point, historical data shows that it is best to ignore this feeling and invest as soon as possible. The author provides data and charts to support the argument that the buy now strategy generally outperforms the average in strategy for various asset classes and time periods. The chapter concludes by addressing concerns about risk and valuations. The author acknowledges that buy now is riskier than average in, but suggests investing in a more conservative portfolio if risk is a concern. The author also discusses the impact of valuations on the buy now strategy and argues that waiting for lower valuations may cause investors to miss out on potential gains. Overall, the chapter emphasizes the importance of investing as soon as possible and provides evidence to support the buy now strategy. It encourages readers to overcome the fear of missing out on a better price and take the plunge into investing. In this chapter, the author presents a game to demonstrate why waiting to buy the dip in the stock market is not a successful strategy. The game involves choosing between dollar cost averaging DCA, where you invest $100 every month for 40 years, and buy the dip, where you save $100 each month. The twist is that, in the buy the dip strategy, you have perfect timing and always buy at the absolute bottom between all-time highs. Surprisingly, even with perfect timing, buy the dip underperforms DCA in over 70 of the 40-year periods analyzed from 1920 to 1980. This is because severe market declines are rare, and the strategy relies on impeccable timing. Missing the bottom by just 2 months significantly lowers the chance of buy the dip outperforming. The author provides charts and data to illustrate how buy the dip performs compared to DCA over different time periods. While there are some periods where buy the dip performs well, such as during prolonged bear markets over longer time frames, it typically underperforms. Even with perfect information, buy the dip is not a reliable strategy. The chapter concludes by emphasizing the futility of saving up cash to buy the dip and the importance of investing as soon and as often as possible. The core ethos of the book, Just Keep Buying, is reiterated, highlighting that consistently investing over time is a more successful approach than trying to time the market. The author also highlights the role of luck in investing and how the market's performance can greatly impact investment outcomes. The next chapter will delve into the role of luck and sequence of return risk in investing. In this chapter, the author discusses the role of luck in investing and how it can have a significant impact on your financial success. The chapter begins with the story of Stephen King, who published books under a pen name and saw them sell relatively poorly until his true identity was revealed. The same phenomenon occurred with J.K. Rowling when she published a book under a pseudonym. These examples highlight the role of luck in achieving success. The chapter then delves into how the year you are born can affect your investment returns. Historical data shows that equity markets go through unpredictable cycles, resulting in varying returns depending on the decade. This means that even skilled investors can underperform due to the timing of their investments. Furthermore, the order of your investment returns also matters, especially when you're adding or subtracting money over time. The chapter provides an example of how the timing of negative returns can significantly impact the final value of your portfolio. The author emphasizes the importance of the first decade of returns during retirement, as a bad decade can have a lasting impact on your financial well-being. However, there are ways to mitigate the impact of bad luck as an investor. These include diversifying your assets, adjusting your withdrawal rate during market downturns, and considering part-time work to supplement your income. Overall, the chapter highlights the role of luck in investing and provides strategies It emphasizes that while luck plays a significant role, investors still have control over their financial future through their saving, investing, and decision-making choices. In this chapter, the author tells the story of Fred Smith, the founder of FedEx, who found himself in a desperate situation. He needed to make a payment of $24,000 for jet fuel, but only had $5,000 in the company's bank account. In a bold move, Smith flew to Las Vegas and gambled the remaining $5,000 playing blackjack. Miraculously, he won $27,000 and saved the company. This story serves as a lesson about risk and the cost of inaction. Sometimes, the biggest risk you can take is not taking any risk at all. This is especially true in investing. While the media often highlights the failures of those who take too much risk, they rarely discuss the consequences of sitting in cash for years and failing to build wealth. The chapter goes on to discuss the importance of accepting volatility in investing. If you want to build wealth, you have to accept periodic declines and market volatility. It's the price of admission for long-term investment success. The author presents a thought experiment involving a market genie who can predict the maximum intra-year drawdown of the stock market. Based on historical data, the author concludes that avoiding drawdowns of 15 or more and investing in bonds during those years would maximize long-term wealth. The chapter emphasizes that volatility is a natural part of investing and that diversification is key to mitigating its impact. It also quotes Charlie Munger, Warren Buffett's business partner, who states that if you can't handle a market decline of 50 a few times in a century, you're not fit to be an investor. Overall, the chapter encourages readers to embrace volatility and understand that it is an essential part of the investment journey. In this chapter, the author shares a personal experience during the COVID-19 pandemic that changed the way they thought about buying assets during a crisis. They were on their way to get groceries when they noticed a man ranging flowers for sale. Despite the chaos and uncertainty, the flower guy was still there, trying to sell his flowers. This moment made the author realize that everything was going to be okay. It inspired them to come up with a new framework for investing during a financial panic. The author explains that market crashes can actually be buying opportunities. They provide an example of investing $100 every month into U.S. stocks from September 1929. The closer you bought to the bottom, the greater the long-term benefit. Every $100 invested at the lows would grow to $440 by November 1936, 3 times greater than a $100 purchase made in 1930. The author also discusses the upside of buying during a market crash. Every percentage loss requires an even larger percentage gain to recover. For example, losing 50 requires a 100 gain to recover. They provide data showing that buying when the market is down by at least 30 usually leads to good future annualized returns. The author reaffirms the upside by asking readers how long they think it will take for the market to recover from a loss. Based on their answer, the author calculates the expected annual return. Even if the recovery takes several years, buying during a crisis can still result in a good return. The author acknowledges that there are exceptions to market recoveries, such as the Japanese stock market, that was still below its December 1989 highs over 30 years later. However, most equity markets go up most of the time. Researchers estimate that the probability of losing relative to inflation over a 30-year investment horizon is 12. This means there is a 7 in 8 chance that an equity market will grow its purchasing power over the long run. The author concludes by encouraging readers not to let fear hold them back from buying during a crisis. They share a quote by Friedrich Nietzsche and emphasize the importance of investing based on data rather than past exceptions. They end the chapter by introducing the next topic, when to sell. In this chapter, the author discusses the difficult decision of when to sell your investments. They highlight the emotional biases that can cloud judgment when it comes to selling, such as the fear of missing out on potential gains or the fear of losing money. To avoid making impulsive decisions based on emotions, The author suggests creating a set of conditions or a predefined plan for selling. The author identifies three main reasons to consider selling an investment: to rebalance your portfolio, to get out of a concentrated or losing position, and to meet your financial needs. Rebalancing is important to maintain your target allocation and control risk. While it may not enhance returns, it helps to prevent your portfolio from becoming too heavily weighted in one asset class. When it comes to rebalancing, the author recommends selling slowly over time rather than selling immediately. This is because markets tend to go up over time, so selling as late as possible allows you to potentially capture more gains. However, the author acknowledges that there are circumstances where selling immediately may be necessary, such as when your portfolio becomes too concentrated or when you need to meet a financial need. The author also introduces the concept of an accumulation rebalance, which involves buying more of the underweight asset over time instead of selling. This strategy can help reduce the impact of market crashes and is particularly useful for those in the accumulation phase of their investment journey. In terms of how often to rebalance, the author suggests an annual rebalance as it takes less time and coincides with the tax season. However, they note that there is no definitive answer and that the optimal rebalancing frequency may vary for each individual. When it comes to selling a concentrated or losing position, the author advises finding a selling methodology and sticking to it. This could involve selling a certain percentage of the position over time or selling based on predetermined price levels. The key is to remove emotion from the selling process and avoid selling all at once to minimize regret. Lastly, the author emphasizes that the purpose of investing is to fund the life you want to live. Selling assets to meet your financial needs or to enjoy the results of your investments is a valid reason to sell. They highlight the diminishing relationship between wealth and happiness, suggesting that sometimes it's okay to sell and enjoy the fruits of your labor. Overall, this chapter provides valuable insights and strategies for making the difficult decision of when to sell your investments. It emphasizes the importance of having a plan, controlling risk through rebalancing, and considering your financial goals and needs. In this chapter, the author explores the impact of taxes on investment decisions and provides guidance on where to invest your money. The chapter begins with a relatable story of receiving a first paycheck and being shocked by the amount after taxes. The author emphasizes the importance of understanding taxes in order to make informed investment choices. The chapter addresses several key tax-related investment questions, such as whether to contribute to a Roth or traditional retirement account, whether to max out a 400 ONEC, and how the author explains the differences between Roth and traditional accounts and provides a simple walkthrough of how each type works. They also discuss the importance of considering future tax rates and individual circumstances when making these decisions. The chapter also delves into the benefits of using retirement accounts to avoid capital gains taxes and quantifies the tax benefits of different account types. The author argues that maxing out a 400 ONEC may not always be the best option, as the tax benefits may be outweighed by plan fees and the lack of liquidity. They suggest considering individual circumstances and financial goals before deciding whether to max out a 400 ONEC. Finally, the chapter explores the concept of asset location and how to distribute assets across different account types. The author discusses the conventional wisdom of placing bonds in non-taxable accounts and stocks in taxable accounts, but also presents an alternative strategy based on expected growth rates. They conclude by discussing the importance of having a consistent allocation across all accounts for easier management. Overall, this chapter provides valuable insights into the impact of taxes on investment decisions and offers practical guidance on where to invest your money. It emphasizes the need to consider individual circumstances and future tax rates when making these decisions, and encourages readers to seek professional help from a tax advisor. In this chapter, the author tells the story of Jack Whitaker, a man who won the largest single-ticket lottery jackpot in American history. Despite his initial intentions to use the money for good, Jack's life quickly spiraled out of control, leading to the loss of his winnings. The author uses this story to illustrate how even those with good intentions and a successful background can be negatively affected by money. The author also shares a personal anecdote about a friend named John who grew up in a wealthy area but didn't consider himself rich because he compared himself to even wealthier individuals. The author then reflects on their own experience of feeling rich during a period of temporary wealth, only to realize later that they were not as well off as they thought. The chapter goes on to discuss how even billionaires like Lloyd Blankfein don't always feel rich, as they compare themselves to even wealthier individuals. The author explains that wealth perception is a network problem where people tend to feel less rich when they compare themselves to others who are wealthier. The author challenges the reader to consider their own wealth and perception of richness. They argue that even if you don't feel rich, you may be wealthier than you think. They provide statistics on global wealth distribution and highlight the relativity of wealth. The chapter concludes by introducing the idea that there is one asset that can make you feel richer than all the rest, which will be explored in the next chapter. In chapter 21 of the book, the author explores the concept of time as the most important asset in our lives. He begins by sharing a thought experiment proposed by a longevity expert, Peter Attia, who asks if we would trade places with Warren Buffett, the richest man in the world. If the answer is likely no, because time is worth more than money in certain circumstances. The author then tells the inspiring story of Dashrith Manfi, also known as the Mountain Man. Manfi lived in a remote village in India where villagers had to walk a treacherous 30-mile path around a mountain ridge to access supplies or medical treatment. After his wife was injured, Manfi vowed to carve a path through the mountain. Over the course of 22 years, he chipped away at the ridge using only a hammer and chisel, eventually creating a path that reduced the travel distance between villages from 34 miles. Manfi's story illustrates the incredible value of time and how it can be used to achieve seemingly impossible goals. The author then reflects on his own experiences and goals, sharing how he set a financial goal of $500,000 by the age of 30. However, he fell short of this goal, realizing later that he should have focused more on optimizing his time and career choices rather than solely on money. He acknowledges that time is the most important asset and that even if he had reached his financial goal, it likely wouldn't have made a significant difference in his life. The chapter also discusses the concept of happiness and how it tends to decline in the late 20s as people's lives often fail to meet their high expectations. As people age, they become more realistic and lower their expectations, leading to pleasant surprises and increased happiness in old age. In conclusion, the chapter emphasizes the importance of time as the most valuable asset and encourages readers to prioritize how they use their time in order to achieve their goal. In the conclusion of the book Just Keep Buying, the author presents a set of financial rules that can help maximize the probability of building wealth. Imagine you are approached by a time traveler who wants to learn how to get rich. They propose a game where you wake up in the past with no knowledge of your current life or the future, but you can give yourself financial instructions. The author's goal in this book is to provide instructions that can lead to financial success regardless of your background. The set of rules, called the Just Keep Buying rules, include 1. Saving is for the poor, investing is for the rich. Assess your financial journey and focus on either savings or investing based on your expected savings and investment. 2. Save what you can. Your savings rate should not be fixed, but rather based on what you can save to reduce financial stress. 3. Focus on income, not spending. Instead of solely cutting spending, find ways to grow your income, as there are no limits to income growth. 4. Use the TWOX rule to eliminate spending guilt. If you feel guilty about splurging, invest the same amount of money into income-producing assets or donate to a good cause. 5. Save at least 50 of your future raises and bonuses. Allow for a little lifestyle creep, but keep it below 50 of your future raises to stay on track. 6. Debt isn't good or bad. It depends on how you use it. Use debt only when it can be most beneficial for your finances. 7. Only buy a home when the time is right. Consider both your finances and current lifestyle before making the biggest financial decision of buying a home. 8. When saving for a big purchase, use cash. Cash is the best option when saving for a wedding, home, or other significant purchases. 9. Retirement is about more than money. Before deciding what to retire from, know what you want to retire to. 10. Invest to replace your waning human capital with financial capital. Invest to replace your ability to work with financial assets. 11. Think like an owner and buy income-producing assets. Use your money to buy assets that generate income. 12. Don't buy individual stocks. Buying individual stocks is like flipping a coin, and it's hard to determine if success is due to luck. 13. Buy quickly, sell slowly, since most markets rise over time. 14. Invest as often as you can. Dollar cost averaging is a better strategy than trying to time the market. 15. Investing isn't about the cards you are dealt, but how you play your hand. Focus on long-term behavior rather than short-term luck. 16. Don't fear volatility when it inevitably comes. Ups and downs are part of the market, and experiencing downside is necessary for upside. 17. Market crashes are usually buying opportunities. Major crashes often lead to higher future returns, so take advantage of them. 18. Fund the life you need before you risk it for the life you want. It's okay to sell and enjoy your wealth, as long as you've secured your financial needs. 19. Don't max out your 400 ONEC without considerable thought. Consider other needs before locking up money in a 400 ONEC for multiple decades. 20. You'll never feel rich, and that's okay. There will always be someone with more money, so focus on not losing yourself in the pursuit of wealth. 21. Time is your most important asset. Money can be earned, but time cannot be bought. The author concludes by stating that we are already playing the time traveler's game in our daily lives, making financial decisions without knowing the future. By seeking the best information and following the just keep buying rules, we can increase our chances of financial success.